glad that we're online. I write a newsletter on the sharing economy, which is currently on a break. And it would be great if everyone could introduce themselves, starting, how about Jordan, you're in my top left of the screen, so why don't you go?
No problem. So Jordan Knopf, I'm one of the co-founders and managing partners at Tusk Venture Partners. We're an early stage venture fund focused on investing in companies operating in highly regulated markets, and we're based out of New York.
Julie, can you introduce yourself?
Hi, everyone. My name is Julie Lean. I'm the co-founder and managing partner of the Urban Innovation Fund. We invest in startups shaping the future of cities. We invest early stage at the pre-seed and seed. And in addition to providing capital, we also like to help our companies with regulatory support as they grow and scale to many cities across the globe. Excited to be here.
Great. And Kevin?
Great, I'm Kevin Talbot. I'm with Relay Ventures. We're a bi-coastal and bi-national fund, so I'm actually in our Toronto, well, I'm not in our Toronto office, but we have an office in Toronto and in San Francisco. We focus on mobility, prop tech, and fintech at the early stage.
Perfect. And I think we might have another panelist joining at some point. There seem to be a few technical difficulties. But so I want to start by talking about the obvious topic, the reason we are doing this remotely, which is the pandemic. I think the pandemic has been a roller coaster for a lot of things, including micromobility. And I'm curious how that has changed the investing perspective.
Who do you want to start?
Well, Kevin, you volunteered. Why don't you start?
I guess the question sort of can have sort of two parts, right? There's the whole pandemic impact on venture capital, and then there's the pandemic opportunity that we see in mobility. Where do you want to go first?
Let's talk about the opportunity in mobility.
I guess I think about two things. The first is that being in the pandemic, there's an increased necessity for safe, effective, appropriately social distance transportation, and we're investors along with Tusk in Bird, and so we take a look at scooter deployments around the world, and it's very clear that that is a very effective, socially distanced form of transportation. So, from an opportunity that's being presented, I think that now is a great time for us to be looking at opportunities that can take advantage of the market environment. I also think that there's been a temporary reprieve on cities in terms of congestion, pollution, aging infrastructure, and issues around accessibility to that infrastructure. So there's a little bit of pressure off of cities today because we don't have as much traffic pouring in, but that doesn't mean that this isn't the time for cities to be looking at new forms of mobility to be able to solve those longer term problems.
I think that's a great, Jordan. I know a thing we had discussed previously was how the pandemic has almost created this opportunity for cities to accelerate infrastructure plans that really go hand in hand with micromobility. Do you want to talk about that a bit?
Yeah, that's an area that we've been watching quite closely, and that's specifically with regards to your larger cities, so your major urban areas across the U.S. and internationally. And I think that just using New York for a second, and watching just the way that people interacted with City Bike and other proxies for how kind of micromobility will take place going forward. I think that I've never seen like the adoption of City Bike, let's call it last February and March, were really kind of fascinating, kind of at the beginning of the pandemic. And New York is a little bit different because there's a lot of people that live here, in the city permanently. So it's not just about commuting to and from work. It's about just getting around. And very quickly, that became the preferred method of transportation. So all of a sudden, no one's taking taxis. Everybody, and this was pre-shutdown or pre-lockdown, and just the the demand that that people had for the product was evident. But then also just you could start to see the payoff that from investments being made in protected bike lanes by the city. And we've seen that, pick up since the pandemic, and New York's done a great job during the I guess slower months of the last year, really kind of focusing on not only providing enough bike lanes by increasing the number of miles that you can cover, but also truly designating them as biker only lanes. So by painting them green, putting protectors, that does a lot for actually for the perceived safety of somebody that's using it for the first time, but also the realistic notion that that's a permanent infrastructure investment that's not going to go away. So it's something that I'm really excited about to see how major cities continue to roll this out, and also just it's not something that has to be just with as much as I would love, because we're investors in Bird, that those lanes be used specifically for the use of Bird scooters. But I think that the bikers and everyone else that's not taking a taxi or a car will enjoy as well.
Would you say the pandemic has made investors generally more on micromobility as a space?
I think it's interesting. Micromobility has gone through quite the roller coaster in terms of the hype cycle, I would say. So, on the one hand, Bird, one of the fastest companies to $1 billion valuation, went out of the gates really hot. Then there was a little bit of that micromobility winter and, kind of the coming back to earth, if you will. And I would actually say the pandemic, it really threw a wrench in the way that we think about more broadly. I mean, who would have thought that commuting, buses, subways, trains, all of the things that we kind of relied on a day-to-day basis from a city, dwelling perspective, would suddenly become really unappealing because we had a global pandemic that nobody could have really accounted for. In my mind, I do think that micromobility has been a bright spot during the pandemic. I think it's shown the versatility, the fact that many, frontline employees were using it, hospital workers, people to kind of get around and, serve the basics that I think for a long time public transit, was kind of the default de facto source of mobility functionality. And now micromobility was showing itself to be quite the bright spot. And so I do think that it's made investors, I would say for us, we continue to think of new form factors. We continue to be bullish on micromobility more broadly. But I think it's continuing to show that, investors are evolving in their thinking because, scooter sharing came out of the gates really hot. And then there was kind of the question around unit economics and how you get to sustainability. And now I think there are other questions in mind, which is, what will the post-pandemic life look like? What will the recovery look like? How do people get around safely? There's certainly been a huge uptick in personal ownership and interest in personal ownership. Will that detract from the appeal of the shared model?
It's interesting because, like you say, we used to talk about micromobility often in context of solving a first and a last mile problem, and sort of assisting people in their public transit journeys. But clearly that has people stay away from public transit during the pandemic.
Yeah, I mean, my personal belief is that micromobility continues to be an exciting category. I think that there's still a lot of room for innovation in both new form factors as well as supporting the existing ecosystem. And I anticipate that it will continue to grow post-pandemic. So we're excited and we continue to look for great investment opportunities in the space.
So how has profitability changed or progressed during the past year? Because I think when we did this panel a year and a half ago, we were just at that tipping point where after sort of a whirlwind of large investments, companies were starting to talk seriously about refocusing on unit economics and prioritizing profitability. And so now we've had some time since then. How have you seen that going with your companies?
Look, I think that I think unit economics were always a priority, and a lot about a lot of unit economics were reliant upon the vehicle systems themselves, and so until you could get to a robust vehicle platform that had fewer parts, was easier to maintain, perhaps had predictive maintenance capabilities built in. And then, of course, the power supply, as soon as we got to large enough batteries that could start to tip the scale on when and how frequently you had to recharge. I think until those evolutions in the vehicle systems themselves took place, then you couldn't get to the unit economics. And so I think the operators have nailed that part, maybe some of them better than others. Whether a company wants to pursue profitability, I think really comes down to their own strategy, and how they plan to interact with capital markets. And so I think generally you see this in waves in all different sectors about do you spend at all costs to grow the user base, and once you get all of those eyeballs, can you monetize them? There are companies that will pursue that model. I don't particularly think that works in micromobility, and I think that at some point in time, you have to shift toward figuring out how to make a sustainable business, and I think some of the operators have done that, or are on the pathway to doing that.
Can you give us any specific operators you think are doing a good job on that?
I wouldn't have couched my words so carefully if I could have.
I have to ask. It's my job.
Of course it is.
How about you, Jordan? What do you?
I think that Kevin and I, as he mentioned before, so we have some mutual interest in portfolio companies. I'd probably want to say one of those names, but I'm going to follow in the responsible footsteps of Kevin and just and not do so.
So also on unit economics, the thing we were talking about a bit backstage is sort of this question of personal ownership versus shared ownership, which Julie also alluded to. And I think, a couple years ago when scooters and e-bikes were still very much a novelty, personal ownership wasn't really a thing most people would even consider. But now, certainly I can tell you anecdotally here in London, it was impossible to buy a bike all summer. Right. And that was a traditional bike, not an e-scooter, an e-bike. But there's clearly been a demand for personal non-car travel devices. So I wonder how you think about that in terms of affecting these companies that their whole platform is built around the sharing proposition.
It's a great question. And I'm more than happy to jump in here at the beginning. I think that one major critical aspect here is the fact that with regards to, the unit economics and also a lot of the things that Kevin had mentioned before about what those strides that have been taken to get to a point where these companies can become profitable, a lot of that does revolve around the innovation around hardware. So if you did decide to purchase a scooter, just like buying a car or something or another form factor, you're still going to not have the latest and greatest in form of technology, or in the form of the latest model of scooter, because all the operators you can assume will continue to innovate on that, continue to come out with models that are more durable, more reliable, maybe have less actual parts, that have better security features from a safety aspect, but also, and more importantly, that require charging less frequently and can go longer on one charge. So I think that that's going to be a decision that comes down to taste and preferences of underlying consumers. Also, obviously I'm in New York, and that's something like this is very your time and how hard it is to actually charge and get a scooter into your apartment is probably going to be a major decision there, versus if you're in an area that a little bit more spread out, maybe have some more free space and it's not as vertical as New York, a little bit easier.
Do you see charging as the main barrier to personal ownership?
So in New York, I don't actually think so. I think that charging is a unique element of itself, right? Like some people that's the beauty of the shared platform. But I think that I don't think it's a gating factor. I think that it's something kind of people's mindset of how they would use it. What are they going to do with the scooter whenever they get to the destination? That's the number one concept that at least I'm thinking through. If I were going to take, and that's why I don't own a bike. That's why I take City Bike. I don't need to worry about it. That's why, if I'm in a city that has scooters operational, I'm going to take a Bird. If I'm not going to take a Bird if I'm going to the airport in LA. So it really just everything is kind of determined based on destination and proximity. At least in the minds of most consumers.
Let's return to this in a minute. But Sarah, welcome. Can you introduce yourself to everyone very quickly?
I'm so happy to finally be here. My huge apologies. We had a lot of troubleshooting in the background, and a huge thank you to Luke. So I am on my mobile phone, so apologies if this isn't the highest quality, but was really been looking forward to this. I'm Sarah Smith. I'm a partner with Bain Capital Ventures based out in the Bay Area. Bain Capital is a global organization. In the ventures team, we focus on partnering with founders who disrupt major industries across a number of different verticals. I focus on micromobility and the future of work, and did a deep dive in this space in 2018, and ultimately led our investment in Lime, where I sit on the board now. And we have a few other investments in this area in Passport, Inrix, and recently had invested in Ike Trucking, which has sold to Neuro. So really excited to be here with you all.
Cool, thank you. So I just want to make sort of the devil's advocate personal ownership of a scooter, which is that if you are to sort of back of the envelope the math on this, right? A lot of scooters, the standard pricing is, but it's something like $1 to unlock and then around 15 cents a minute. So if you work with those rates and you assume, we usually talk about less than 5 miles, so 3 miles of a trip, and that you can't go the top speed for the whole trip, you're probably looking at that trip costing between $350 and $450, let's say. Meanwhile, you can buy sort of the standard consumer adult scooter for a bit more than $600, which means that if you continue to rent, it becomes cheaper to just buy your own electric scooter after about 4 months of commuting. Do you think this will be a compelling case to someone who uses a scooter enough to be actively participating on most of these platforms? Anyone can.
So I'm going to just jump in real quick. I think some people are going to buy their own scooters, and some people are going to share scooters and rent them. And I think we're just going to see this stratification of the market the way we do in virtually other forms of transportation. So the whole idea, as Horace likes to say, that you prepay for a 3 or 4 year option on a vehicle that sits on unused in a parking lot 90% of the time. People still buy cars, and then people take Uber, and people rent cars, and people use car share. So I think we're going to see this whole stratification. I do believe, but back to your point, there will be some people who will do that calculus, and because the scooter is part of their daily commute, they may say that they should pony up the money. But I think there will be others who look, maybe I have my own scooter in San Francisco, but when I'm visiting New York, I'm going to use a shared bike or shared scooter. I think that is going to be the norm.
Does anyone raise your hand if you own either a bike, traditional or electric, or a scooter? Okay, we got 2, 3.
Traditional bike. Yeah.
Traditional bike. Okay.
Traditional, yeah. Well,
Yeah.
I would
so
also
the traditional bike, it's a winner.
Well, Alison, I would also just point out that, we are in a unique moment in time, right? We've seen this huge surge in personal ownership interest, and with car ownership, I mean, there's been a huge influx in car ownership, regular bike ownership, to your point. And the real question is that something that's going to continue after the pandemic? And, if you purchased a vehicle, certainly you will still use it, but I predict that shared models will continue to be kind of the going way for a lot of people, especially because they present fewer barriers to entry, and there isn't as much of an upfront price tag to it. So I still feel very bullish on shared ownership, but I definitely think that the pandemic has given a unique moment in time to personal ownership when sharing economy seemed to be all the rage for the last decade or so.
It's interesting. I was just going to say, it's if you look at like the car purchasing trends, like once we got more information about the virus itself and how the likelihood of transmission by touching, handlebars that maybe somebody else had touched previously, versus the likelihood of transmission via contact on a physical surface versus where we are today and what we know about the virus today. I think that probably does tell you that explains the uptick in the use of the shared shared city bikes or scooters that we've seen to date, but also kind of the slowdown of car sales or new car sales or new car leases between May and today. So we are still in a time where we really shouldn't have seen a new purchase drop like we have. And I think that's just the people getting comfortable getting back into Ubers because they feel that they're safe. They feel that they're able to protect themselves. They know what to do to avoid or to minimize the risk of getting infected with COVID.
Yeah, I'd add to that. I think it's also important to remember we're just still in the early adoption curve in general for consumers with electric personal mobility. So, just like people own cars and still use Ubers, or people still own clothes but still use Rent the Runway, I think we'll find the same thing where people will own electric bikes or scooters but still use shared mobility. But there's still a huge portion of the population that haven't even tried an electric vehicle. So I think there's a lot of room for both. And tourism is actually a way that a lot of people initially get into this. And so that will continue to spread as travel picks back up.
Within the shared operators, we have sort of seen most of the consolidation we will see, or should we expect more of that? And how well do you think the current players are doing at differentiating themselves? I'm reminded of an anecdote from a panel last time where Tim Bradshaw of the FT was on stage with about half a dozen scooter operators, and he said to them, I want you to tell me in your introduction what makes you different from everyone else on this stage. And someone from Cirque went and he said, we have a great team and our scooters are orange. And then 2 people later, someone from Voy went and they said, we were orange first. So that is my classic tale of scooter differentiation.
Yeah, I think there's probably a room for a bit more consolidation. I mean, we're still literally and figuratively in winter with COVID and seasonality. So there's probably a bit more consolidation that will happen. And certainly we're not seeing as many new entrants now as we saw, 3 or 4 years ago. I think people have figured out this is really hard to do and you have to be at scale to get to good unit economics. I mean, I think the differentiation can come in a number of different forms. Some can be in the way that you package up the offering to consumers. Like, do you do like you said, the unlock per minute? Do you do some type of subscription service? Do you offer the opportunity for people to reserve ahead of time? Like, reliability, convenience, and proximity to the rider is really what they care about. So whoever can pull that off the best, your scooter can be green, red, orange, or yellow. I don't think that's the thing that makes people choose one or the other. It's really the reliability, convenience, proximity, and safety that matters the most.
Yeah, I couldn't agree more. I was just going to say that at the beginning, it was kind of fascinating because people weren't asking these questions, what makes you different? Everybody just wanted more scooters on the road. It didn't matter. You're an investor in Lime. Kevin and I both investors in Bird. That was at the early days. It was good for both businesses. Just get because people are doing exactly what they would do with Uber and Lyft. I'm not going to wait 16 minutes for. I'm going to pick. Do I have my go-to app? Of course, but then if wait periods get out of hand, I'm just going to open up my other app. And how far away you are from the scooter is really, really, really important. And in those early days of adoption, both companies that were the first, kind of companies to get out of the gate, I think they both benefited tremendously by each other actually being in competition, because they were able to saturate the market much faster and get enough scooters out there where people could have an experience on them that actually got true adoption.
What I was going to ask is, do you think we're seeing fewer new entrants now because we've started to hit the point of market saturation? Do you think it's because there's just less VC funding available for a new scooter entrant at this point? Like, why are we seeing fewer new players?
Well, look. Here's a more general sort of statement about venture, and that is it's a Darwinian marketplace, right? So at some point, it's not going to be about what color or what business model or what design features. It's going to come down to, this is a very capital intensive business, unlike most of the companies that we all invest in. You need network operations capabilities, whether you're in one city or 120 cities or 200 cities. I mean, the bigger you are and the more scale you have, the more cost effective everything is. And you're either going to build a business out of this or not. And so I think that's why, there will be one or two companies that operate globally. And I really don't think we're going to have very many regional players over time. So I'll just come back to, I just think at this point in time, the smart money has sort of seen how expensive it is to launch, scale, and operate. And I don't think that there's going to be a lot more money falling into brand new operators with an undifferentiated value proposition, and quite frankly, not enough scale.
It sounds like, though, where we have seen competition is in a separate layer of companies that provide management tools to cities to help them integrate micromobility. Does someone want to talk about that a bit?
Yeah, sure. I'm happy to jump in. One of the theses that we kind of had around micromobility was, do you invest in an operator, or do you invest in kind of the picks and shovels part of the business? And we kind of went the latter route. And so we ended up investing in a few businesses that kind of provide services to the broader ecosystem of micromobility. One example is a company called Ride Report. We essentially help manage regulation, compliance, and payments around the micromobility space. We've been involved with them since pretty early on, and they've kind of grown and spread to many cities across the US and beyond. We think that there's room for more players that are really helping facilitate various elements of the micromobility ecosystem. And so we're excited to kind of continue supporting that space. What I would just quickly say to the prior conversation around new entrants and, differentiation, I think one thing that really does differentiate the micromobility ecosystem from other parts of transportation and mobility is, the regulatory landscape does look really different, and it's often determined on a city by city basis as opposed to a state or kind of federal basis. And so that, I think, has created a lot more opportunity for, smaller cases regional, but in other cases just players that can operate in a few cities, or they've been able to kind of capture market share in ways that other larger players haven't been able to break through. And so I think that in order to see more of that consolidation, or those players that kind of take over the US or even global, I think we'll have to see more uniformity on the regulatory side, which I think will be a huge question mark moving forward, because it does seem like cities always like to throw a wrench in the plans when it comes to, figuring out the right regulatory scheme, or, who gets the scooter permits.
It's interesting.
They learned the hard way with Uber, didn't they? Sorry, go ahead.
Yeah, no, because you're spot on the state and local regulatory component, and the hurdles that presents, but it also does unlock some opportunities here, because if there's one thing that we know right now is that, I mean, at least where I am in New York, I don't know about everybody else, the cities are hurting. The cities in the States, from a revenue perspective, I don't know that anybody had a good year this year, that's for sure. So, but whenever things are working in a city and the budget looks really, really good, that's whenever regulators are going to have, well, should the scooter be on the sidewalk, or should it be in a parking place, or do you have a lock on it? Or we have way bigger problems on our hand right now. Like, we were sitting here, 1 in 4 people in New York can't put food on the table right now. So I think that if there's an opportunity to seize the moment and provide a city with a service that you think can drive A, revenue to those cities or states, B, jobs to those cities and states, and C, a way for people to safely move around the city, that's something that they really, really want right now. And they're going to be less caught up with the nuance about the operations and, the complexities from the back end, and a little bit more focused on the big picture and the bottom line. And the bottom line is that introducing these concepts drive revenues to the city government. And that's really, really important.
And Ali, Ali, I've been watching some of the chat comments. I think a really good point that's been made. We keep talking about San Francisco and New York, but there are a lot of cities. And I'm not going to call them, and I don't mean this in a derogatory way, but I'm not going to even think about tier 2 cities, but even like tier 3 cities. And I'm just talking about in terms of size. And I think there's huge opportunity for micromobility in those markets. I know we've been really focused on big centers, but just in response to a couple questions people have asked, I think there's still big opportunity.
Probably one of the most lucrative ones for college towns, right? I mean, that's about as good as it gets. And, from a safety and a use case, not to mention the fact that you have a lot of people that are ready to help out and have their hands raised on the charging front. I can't think of a better way to do that than by putting a bunch in your dorm room. And so it's something that I think shouldn't be the impact that's going to have on ultimate revenues and for these core businesses. I think that as you just pointed out, that the market leaders are going to be the ones that really execute flawlessly in those types of markets that are at the longer end of the tail than your core obvious major urban dense areas.
Well, Kevin, since you brought up other markets that are not New York, London, San Francisco, a question I had was, do we have a sense of the demographics of the typical scooter user these days? Like, I know there were conversations a year or so ago about equitable distribution and how effective operators were at getting scooters and bikes into lower income neighborhoods, making them accessible. Like, have we seen platforms deliver on those commitments?
Oh, I think so. Look, I don't think it's easy.
Kevin, I think you're muted. Still muted. So maybe someone else can answer while we sort the mic.
Yeah, so I'll just jump in on that. So the fair and equitable distribution, I think that's been a core objective of a lot of these operators, and I think that a lot of that happens at the launch and partnering with cities. So, in a pilot, one really, really great way to get these operational and to prove out that you can provide what in some areas there's always access to public transit is always a problem, and you create these transportation deserts where typically in lower rent areas it's harder. You're further and further away from reasonable public transit options, and those are probably the best places to launch. You're able to prove product market fit, safety of operations, and that you're providing something that's really needed for the city. It's not everybody dumping scooters in Union Square. Sorry to use another New York reference, but it's in my backyard. I think that it's something that's a major problem, is that getting people into the city from the outer boroughs where they could need to walk for 20 minutes just to get to a bus stop to ultimately take them to the subway to get into work. So, that I can't think of a better use case than kind of the outer boroughs and proving that out with in areas that really need the help.
Sure.
I was trying to find some of the latest statistics of what we found, at least at Lime, but I do know that, at least as of a year ago, when we looked at this, part of what gets me excited about these companies is that a lot of value to a broader population than that kind of build for the 1%. And we saw, I think it generally, from a gender line perspective, skews a little bit more male. And I think that's something that all the companies are thinking about. Just if you think about even attire and what you wear to work and when you're commuting, like it just might be slightly different for men and women. And how can we develop transportation options that service women just as well as men? They're simple. We also see, I think, slightly better gender distribution on e-bikes. And so it kind of suggests that either having that basket you can put something in, or just safety in general, like just the feeling of being more safe on a bike tends to appeal a bit more to a broader gender audience. We've seen pretty good racial distribution actually, and income distribution. So I think it speaks to the commute use case as well, that we see, it really does make a big difference for people that are maybe stitching together multiple forms of transportation. And then of course the point that Jordan, we do, many cities, rightfully so, do have equitable distribution requirements, based on different neighborhoods. And so that certainly contributes as well. But I think it's actually one of the most promising parts of micromobility is that, we are serving the everyday person in all of our geographies.
So anyone who has a question should drop it in the chat and we'll try and take a few before the panel wraps up. But in the meantime, another thing I wanted us to talk about quickly was just what it's like to do a deal when everything is remote. I think traditionally we talk about venture capital and investing as a very in-person process where you take the meeting, you sort of look someone in the eye and size them up. And obviously now we can't do that because of coronavirus. So I'm wondering how you feel that like deal flow and meetings and just the process has changed in the past year.
Yeah, I'm happy to jump in. I think when the pandemic first hit, everyone was kind of in hunker down mode and really trying to figure out how to look at your existing portfolio, make sure everybody, was taking responsible measures to cut costs, make sure that they had enough cash on hand, runway, looking at PPP. But I think things changed a lot around, Q3 and certainly Q4 of 2020, where, the private or the public markets continued to really be very robust. And I think the private markets followed suit. For us as kind of pre-seed and seed investors, we had done deals entirely virtually and entirely via Zoom, but I think our mode of operating switched very quickly to that being the default, which is a really different change of pace. And one thing that we've been excited by is the fact that follow-on investors are also following suit, because I think at the early stage, pre-seed, seed, that's one thing, but can you get a Series A, a Series B deal done entirely remotely? And we've seen many of our companies be able to do that and do it pretty quickly, depending on the circumstances. And so I think people are adjusting to the fact that we're now in a much more, globally remote society. And I think excited to do a lot of deals from what I've seen. So it continues to be a pretty robust market for early stage funding. And so I think it's an exciting time to be an entrepreneur.
Yeah.
Can you hear me, Ali? Am I back?
You're back.
You are.
And since
Okay,
Welcome back.
sure. Okay.
Just
Go ahead, Sarah. Sorry to cut
you
you off.
might have missed the prompt. We're just talking about how, if at all.
I heard.
Okay, good, great.
I was going to say, so I have done a number of fully remote deals so far, but I think for the industry as a whole, the real test is going to be over the next 6 months, because I think the last 9 months, a lot of people invested in people that they had met in person at some point and had built a relationship with. So I think we've seen a lot of people they'd already met and they were sort of tracking for 6 months, and they kind of went back to the well of people that they know versus cold start relationships over Zoom. I also, it's anecdotal, but I do think probably depends on how long you've been doing this too. I think for people who've been doing this for 15, 20 years and, are very used to this sort of safety and security of like, I've sat across from you at a table, we've had that connection, versus maybe those of us who've been in this for 5-ish years, we're a little more, maybe more comfortable taking that risk without that data point. For me, it's an interesting test of founders. So many of our founders are going to be managing through remote for the next 6 to 12 months, and their ability to communicate and connect with people, not only investors, but they have to do that with their teams too. And so if I feel like they're able to do that well with investors, that gives me even more confidence in their ability to lead through what is like a lot of uncertainty over the next, 12 to 24 months. And I would add to the pace has picked up. I mean, the volume of meetings, I think multiple days this week, I did 14 different Zoom meetings in a day. And definitely if I look back in my calendar 2 years ago, there's no way we were doing that volume of meetings. So it does mean that rounds are moving really fast because a founder can meet 8 different VCs in one day, whereas before maybe they could meet 3 or 4. So it's kind of picked up the pace.
Do you think that also means that people who before might not even have gotten a meeting are getting more chances now because there's like a lower cost to taking that initial meeting?
Probably true on both sides, actually, in both the founder side and the investor side. Because if you can make double the connections in the same amount of time, that kind of increases the odds on both sides. So I would say that is probably true.
Yeah, I mean, the deal velocity is there. I mean, definitely shows it, right? I mean, I think that once people, and I think at the beginning, there may have been a little bit of a hiccup on the funding side, just as VCs figured out whatever their internal processes were, like how to adapt as quickly as possible to, a lot of people have Monday meetings where their entire partnership is there and to do a deal, that's the process that they have. And they were kind of blindsided by this, but I think people moved really quickly to figure out a way that makes sense to get to get deals done. And it's also kind of just like the velocity that you can have more meetings, you also have the ability to just engage more frequently, more touch points and in different environments with an entrepreneur, because it's always interesting to see, what an entrepreneur is doing in real life. And whenever they're sitting there and their kids are jumping all in the background and, it's the same thing on your end, that kind of does bridge a unique kind of gap, or it kind of accelerates that relationship that you have with the person, just because you get to see them in a different sort of element. It also allows you to not necessarily have, okay, let's do another deep dive in our office with you and 4 team members again. Let's just do that in like 20 minutes on Zoom and just crank through it. So it's definitely, I think that the way that funds have been raised traditionally and during the pandemic, I don't think that we ever go back to a fully must-have a formal in-person partner meeting before a deal gets done. I don't think that ever happens again.
So I'll agree with everything that's been said. I think that what happened when Jordan referred to sort of hiccup is that, I think we all thought we better pull out our playbook for what happens, when a catastrophe or a financial markets collapse. And it didn't play out that way. So there was that sort of, pause, and then everything just kept going. So as long as you didn't work in tourism or airlines or restaurants, then it seems like life, continued just fine. Which is very strange, environment to be working in. But the only other thing I just want to add, I agree. I think it's easier for entrepreneurs to get a meeting because the cost for us is, virtually zero. And there's just more opportunity, and there's just no reason not to, take one extra. Like if you're doing 12, meetings in a week, why not do 14?
And it's also just post-pandemic, it's going to be easier as well. And even if it's not somebody that's coming from within your network, or it's and which is great from a macro sense, just as we all continue to think about how to kind of create an environment where different types of entrepreneurs that are not necessarily tied into the venture ecosystem right now, that may come from different types of backgrounds than your traditional or what we've seen the last 10 years. This is kind of a chance to for really everybody to reflect on their current deal flow and expand those networks. Because now I think everybody has new connections that like just off of this panel of people that they're probably going to connect with offline, offline via not on a panel, but where you can make new contacts, people that are outside of your geography and in completely different walks of life, and I think that entrepreneurs should really take advantage of that.
Geography is the key word. I think I think that's what changes forever. I think, pendulums swing, and I'm sure everybody on this call and everybody who's listening, we're all like dying to get back to a traditional meeting, to sit across from other people. So I think, the pendulum will move. I don't think it will go all the way back to the way it used to be. It's going to settle back somewhere else. But I think one of the other lasting changes is going to be finally that the venture community is less constrained from a geography standpoint. I think that's going to be a good thing.
Yeah, there's a question in the chat about VC being traditionally a fairly white male industry, and so I think also related to just sort of the remote deal making process. Have you noticed, has that enabled more diverse investments at all?
So it's really interesting. It is somewhat, I can only speak for myself and in our deal pipeline and what the deals that we've done, and they're definitely skewed a bit because there are certain sectors that attract more women than men. For digital health is a great example of that. So if your deal flow is picking up and you're doing more digital health investments, naturally you're going to skew that you're backing more women if women are 50% of the entrepreneurs there. Now it's so I think that does matter, but either which way, I think that the focus is still needed. Geography and doing this on Zoom isn't enough to really level the playing field there. So I think that at least from our perspective, there's always more that can be done, and I just don't think that Zoom alone solves that problem.
Yeah, I mean, I would just quickly jump in and say that it's really one thing that's very disappointing is that they showed a statistic on the number of female entrepreneurs that have gotten funded during the pandemic. And apparently the stats show that actually there are fewer female founders that are getting funded. And that's not only extremely disappointing given the fact that the stats were pretty abysmal to begin with, but it's somewhat surprising because on the one hand, I totally agree that borders have been opened. The fact that everybody's remote has really shown an ability to, connect with people all over the world from a deal flow perspective. But I do think people, might be defaulting to either folks that, have network or other kind of proxies for, hey, we can't meet this person, in real life. So what are other ways that we can kind of use? What are other heuristics that we can use? I'm only guessing. I can't, explain why there are fewer women that are getting funded, but it's obviously an alarming trend and something that, I think it really takes an open network and, taking in a lot of cold meetings in order to diversify the pipeline. And my hope is that folks will continue to do that in the venture community because we desperately need to kind of diversify the entire entrepreneurial pool for folks that are getting funded.
I totally agree. I think this is a story not being talked about enough, actually, is that 2020 was horrible for women generally in the workforce and certainly in venture and entrepreneurship. Most of the job loss in the US last year can be accounted, by women. And so it's really set us back. And I think people are really underestimating how bad it is. So we have a lot of work to do. I personally think, there's just no question there's always going to be bias in this industry. Like we are making gut calls on founders and ideas and markets, and you can get objective on some of the things, but at the early stage, it's still a lot of subjectivity. And when, less than 11% of GPs at firms are women, for example, and it's even lower for people of color, there's just, we know how this works, that people just generally like to back people that they identify with. And so it's just going to be natural that people tend to meet with people that look like them and seem like them. And I certainly meet more women and founders of color than probably my male colleagues do. That's just my network. And so a big part of this is going to be firms diversifying their own partnership if we actually want to change the makeup of the founder landscape as well.
And just to tie it all back, I guess that was the original genesis of my like expanding the network comment. So, basically, if you're not getting outside of your current network, you're not doing anything that's going to solve for the problem. But I think that the key takeaway that hopefully that people are really like reflecting in and not just looking at how do we press the fund button and basically back more people that are not just like the whoever started the firm, but making those changes within and letting actions speak louder than words. And proof is in the pudding. We're making changes internally by bringing on more people that represent that growing diverse mix of people that they'll let them make the decision to go fund. And naturally you'll have a more diverse set of entrepreneurs in your portfolio than if you're just you're literally just saying that's great, but I'm just going to back more people that don't look or identify as the same way I do.
One really encouraging thing I think of the last year, though, could be this rise of the solo capitalist. So there's the angel fund, rolling fund product, where a lot of operators who might want to start doing angel investing or even pre-seed seed investing can, in a pretty lightweight way, start to go out and raise funds and do SPVs and to start their own syndicates. And I think a lot of, in the past, people that got into GP roles had to be founders, CEOs, which is already a pretty homogenous group from a demographic standpoint. But you start dipping down more into VP and director level, or even below that, of people who are network rich but cash poor, and now you give them the tools to be able to go out. I think that actually could be a really interesting and like way to bootstrap more diversity in venture at the early stage.
So we have about 5 more minutes. Should we talk about GameStop? Okay, no, that was a joke. We're not going to talk about GameStop. I know everyone wants to do that. Okay, so this has been really great. And I guess just to close off, it would be great if everyone could go around and maybe say something they're excited about for the next year of Micromobility. Jordan, you're still in my top left corner, so why don't you go first?
So I'm really excited to see what happens whenever cities start to reopen and we start to see what hopefully is a more permanent. I think we're all speculating on what the consumer mindset is going to be post-pandemic. And I'm excited to see what that looks like in the case for micromobility, particularly in regards to new cities and market expansions into smaller and kind of not marquee cities across the U.S. and across the globe. Also, just new market entrants with differentiated products that really build on this ecosystem. So it doesn't need to be an electric scooter and it doesn't need to be tied to servicing one, but there's no shortage of ideas. And this is a new area that really kind of transportation is always going to be required. And it's always going to be something that there's a constant amount of innovation around. And I just think that this is a really, really exciting place to be right now. And a lot of capital and infrastructure has gone into this, and it'll be amazing to watch once the globe gets up and running again.
I'm happy to go.
Sarah, how about you? Yeah.
Sure. I'm really excited about a few things. I know we talked about some of the smaller cities, but I'm really excited to see some hopefully larger cities really tip and adopt micromobility in a big way, like New York and London, especially because of I do think there's going to be sort of revenge tourism as soon as we can all travel again. And I think those cities are going to see massive amounts of new tourists who will try micromobility for the first time. And so, again, I think seeing us go further along in the adoption curve of micromobility is super exciting. Lime just announced a couple of days ago our e-moped pilot in Paris and DC. And I think it's just, one of many evolutions of trying newer forms of micromobility beyond the scooter and the bike, because anything we can do to maybe increase the range from, a 1 mile comfortable trip to 3 mile to 5 mile comfortable trip for a range of use cases, again, just makes that reliability and dependability that consumers really need is super exciting. So I'm just hopeful this is going to be a year of even greater adoption and more modalities in large and small cities.
Julie, what about you?
Well said all around. I think one of the big questions that we've gotten over the last, 10 months or so of the pandemic is, are we going to see the death of cities as we know them? Everyone's relocating to areas that are more rural or suburban. Are cities essentially going to, die? Or at least the big trend of moving towards cities, is that going to essentially go up in smoke because of the pandemic? For us, obviously, being the Urban Innovation Fund, we're extremely bullish on cities. And I truly believe that this will be kind of a renaissance period for reimagining the way that we live, work, and get around cities. And so for us, we're just really excited to see what happens, whether it be, kind of in the post-pandemic life, or whether, it's revenge tourism or something else. I think we're going to see a lot of different habits, and specifically, people are going to be working remotely more often. Commuting has really taken a nosedive, and people will want to see areas in cities where, maybe they're not jammed in gridlock all the time. And so I think that there's a real opportunity for adoption of, new mobility solutions, whether it's the existing players as well as, maybe new form factors that we haven't even imagined. And so we're really bullish on not only the future of cities and the revitalization of cities after the pandemic, but also, what happens in mobility more broadly. And I think it's going to be a really exciting kind of renaissance period in the startup space.
Great, thank you. And Kevin, can you tell us your thoughts on the next one?
I will second everything that's been said, and let me just end off by saying, in 2020, venture globally, 25,000 companies were funded something like $460 billion. And in the transportation sector, it was a little over 1,000 companies and about $33 billion. So I am very excited about the transformation that can occur in this sector. And I think it's still early and nascent, but there's capital that is going to find its way to this sector. And so I would just encourage, the entrepreneurs out there. The entrepreneurs are the smart people in the room. Because if we were all, really super smart and we could figure out, what the future was going to be, we would be inventing it. So I think there's just a tremendous amount of opportunity for the future of mobility.
Okay, well, thanks. I think that about does it.